Thank you again for being here. It's nice to see everyone.
Are we going right? Okay.
At this point, we're turning the discussion to the supply side, opportunities and challenges. Now, based on our forecast, we expect the LNG market to be well supplied by mid-decade through 2030, and that's to say nothing of the tremendous amount of capacity in development, which, looking out, can potentially result in some real oversupply as well. But we also see a couple of other things. We see the need to keep LNG profitable through the cycle, something that's come up a few times so far today. And we also see the need to keep LNG affordable and competitive over the long term, which requires lower cost volumes. So we're here to see if the factors that have driven project FIDs will continue to drive additional project advancement. And we're also here to consider what sorts of cost and commercial and even climate innovations are needed to get projects over the finish line, and to get them over the finish line in an increasingly competitive environment. So to answer these questions, we have really a top-notch line of panelists representing a diverse group of companies and ventures and an expert view from the financing point of view, and I'm very happy to have them here on stage. So it's a privilege to welcome Mark Gyetvay from Novatek, Katan Hirachand from SocGen, Michael Sabel from Venture Global, Andrew Seck from Total, and Delray Venter from Shell. And because we're cognizant of time, I would say please look in your programs for their terrific bios. Okay, so Mark, let's start with you. No, let's not start with you. Let's start with Delray. Delray, Mark, we'll get to you in a sec. Delray, you're all the way down there on that side of the stage, but I think before we get into the innovation piece of this, what are you thinking about how short-term, near-term, and sort of weak market conditions are impacting decision-making in terms of LNG projects?
Yeah. Well, what we see today, of course, is that the market is relatively well supplied. And that is a good thing, because the last thing that the LNG market needs is another extended period where the market's tight, prices are high, and then, buyers looking to convert from liquid products to gas or from coal to gas wonder whether they can trust in the affordability and the availability of LNG long term. So let me firstly say, where we are with a relatively ample supplied market is a good place to be in. Now, the effect of that, of course, is that you have a relatively low spot price. And there's a lot of talk about, increasing commoditization of the LNG industry, and to quite an extent that's directionally at least true. The key difference between LNG and other hard commodities is that it's very hard to store LNG, right? So you cannot build up large inventories of LNG like you would have for metals at the London Metal Exchange or the CME or so on. And so therefore, your spot price will forever be particularly sensitive to periods of market tightness or the market being sufficiently well supplied. That volatility is really hard to handle. And so for folks who are heavily geared when they start up a project, if you start up your project in a window where the spot price is at $5, it's not great for your return on capital employed. It's not great for your payback period. And so even though today there's far more capital available to fund LNG projects, capital that's not held by banks or ECAs or large corporates, that capital is still really worried about price volatility and is still incredibly scared about volume risk and offtake risk.
Interesting.
The other point that I would make about the spot price is it really drives buyers' perceptions. So the boards that sign off on these long-term deals, if you're a project developer and you want to have a bankable contract, you have to do that on a long-term basis. boards in these companies, they're reading the Financial Times, they're reading newspapers, and they say, hey, I can buy LNG for $5 or $4.50. Yet their long-term strategic people are coming to them and saying, we would like to purchase long-term LNG linked to oil. And he's saying, well, if I can just buy spot at $4 or $5, why do I bother making a strategic commitment to a given project or a portfolio player? And it really makes the decision-making to commit strategically to a project very, very difficult. And this is why I think it's better on the demand side. This is the period to really create demand. It's going to be much harder for people to justify new projects beyond what has been initially done and perhaps things that have already got quite a bit of momentum over the next 6 to 12 months.
And this is really getting to the question that I have for you, Mark, which is getting to the cost innovation side of this question. What I'd like to hear from you on, when we're looking at cost innovation, there are several pieces to this, but on the technology side, or should I say not just on the technology side, but on the liquefaction kit side, would you say that maybe all of the cost savings have been wrung out at this point in terms of that technology, or do you think maybe there's still a way to go to make liquefaction less expensive?
I would say that first and foremost is it's a cyclical cost period. When you have many projects going at certain times, you seem to see a shortage of suppliers, shortage of contractors, et cetera, and we see a run-up in cost. And I think we're actually working our way back down again to maybe what LNG liquefaction per million tons was maybe a decade ago. And I think everybody feels reasonably comfortable that if you can bring a project on stream in the $500 to $600 to $700 million per ton, you pretty much wrung out as much as you can potentially wring out in a particular cost of this type of complicated type structures. But there's other things you can do. And I can give you an example. We just completed Yamal LNG, and Yamal LNG was built onshore with a massive amount of infrastructure. It's built on permafrost, so it had to be built on pilings, et cetera. There was a lot of extra cost that had to be built into the process to take the sensitivity of the geographical location. So now we're moving forward. We just took an FID on Arctic LNG 2, and that project will be completely redesigned based on what we learned from Yamal LNG, but it also took into consideration the innovation and technology that's out there today, and we're able to now, bring a project on the drawing board that's what's called gravity-based structure. So it's completely condensed the whole project into a large barge that basically houses the liquefaction, power, compressor, turbine, storage, loading arm, et cetera, and that reduces the geographical footprint by each train by about a quarter of the size that we did at Yamal, which from an environmental perspective is great, but it also allowed us about a 30% cost savings. But I think we're pretty much at that range of 5 to 750, and I think if we can stick in that range, I think you'll see projects move forward.
And if I can turn, Michael, to you, we've heard the Venture Global story about its own liquefaction kit, but I'd like to hear from you about other areas in the value chain where you think there can be some cost reduction. Are there other areas that jump out, and if so, what's at the top of the list in terms of maybe the most important or the biggest ones for improvement?
Yeah, sure. We initially started, Bob and I did, with a different approach to configuration, so the kit or the equipment, as you were just referring to, where we reduced our train sizes down for 10 million tons down to 0.626 MTPA. So we have 18 trains for our 10 million tons. And the thought process there was to push that liquefaction in the process system into factories, so we get traditional factory savings. To answer your question, though, the configuration and the way that our fabrication and construction gets sequenced as a result of having so much of it done in a factory, create lots of other opportunities on the contracting side, on the financing side, that really are byproducts of how we configured the project and how we shifted risk from custom construction by an EPC in the field, the traditional approach, into the OEM, the manufacturer, and really using models on that side that aren't that different than the power industry, for example. To give you one metric, as a result of that, our peak labor force, the direct labor force on site is going to be around 2,200 people, compared to projects that are kind of 10 to 15,000 for our size that the rest of the industry is experiencing, because we've shifted a lot of it into a factory setting, and so it's that we have, in our view, reduced the cost of the process system equipment itself, but that ripples through in lots of other ways: labor cost, risk, which particularly for project financing and even IOCs directly correlates to cost. It shortened our construction time as well. We knocked a year and a half or more off the construction. So that's a huge savings in interest during construction, which is a massive number, so it's all related.
Yeah. And Ian, probably I'll maybe pitch in at that point. I mean, you talk about, costs. I think financial engineering plays a big part in this as well. Michael's just kind of alluded to a couple of areas, but I think I'd probably distinguish firstly North American market from the rest of the world, because there you've got a very good basis, because you've got bank versus bonds, and you've got the ability to finance with banks and then take out in the capital markets once construction is through or construction is close to being through. The other area, which I think, again, probably the US has excelled in more, is, if you're a developer or you're a major, you don't necessarily need to own these assets. Yeah, you can, as long as you have access to the assets, someone else can own it. And that someone else can be, a variety of different investors that don't need the sort of double-digit returns that E&P companies need. We're talking, 5, 6, 7% in some cases. So that would have an immediate impact in terms of your ability to deliver the molecules more competitively. I, for one, feel that needs to happen more outside of the US now as well.
Sorry to interrupt. I was just going to add, the more long-term contracts you have in your portfolio, the better the credit is, the more you can access those lower costs of capital that we just heard, and so they go together.
And if I could just build on that, I think there is a lot of focus, rightly so, on capital costs, right? On whether it's 450 or 550 or 650, and that's important when you launch a project. But ultimately, what matters to the customer is the landed cost of a molecule of LNG when it sort of gets into the arms of the customer, right? And so within that context, I think operating cost is often overlooked for the important thing it is. There's perhaps mistakenly as sort of a sentiment that all LNG plants have similar operating costs or ballpark similar operating cost structures. That's actually quite far from the truth. You have to design for low OPEX. You have to be really excellent at operational efficiency for low OPEX. I think OPEX plus improving shipping costs, plus reducing regas costs, plus reducing in time, and I hope soon, cost for greenhouse gas of the chain as well. All of that will have to play powerfully as we continue to drive LNG down the cost curve, because if we think that we're sort of at the bottom of the cost curve today and $500 a ton sets a good precedent for the future, that's not where we are. I think what we consider to be a competitive landed cost is something that keeps on coming down as the cost of some important competing energy sources continues to come down as well.
I'd also like to add that the innovations that are applied in one project may not necessarily be the solution for another part. So, for instance, Venture Global has very successfully used modularization. Well, we looked at modularization for Mozambique, but we discounted it because one of our most important stakeholders is the government of Mozambique, Mozambique is a very poor country. What are they interested in? Employment. Stick build provides more employment. So we have this traditional size, big labor force. So that your solution doesn't work, but our solution in the Afungi Peninsula, and again, driven by the government of Mozambique that didn't want to see a repetition of what happened on the east coast of Australia, where you had 3 competing projects with 3 sets of identical infrastructure. They forced the Area 1 and Area 4 consortiums to come together, and we've agreed to share infrastructure, which is a means to reduce the cost. So your solution doesn't work, but we found an alternative solution that allowed us to deliver the competitive cost LNG.
Yeah, I see, and that's a little different than what we did, because Yamal was the largest modular construction project in the world. And I think people have looked at that model and have adopted certain elements of the processes. Like, we use Technip FMC, and so I know companies that are using them today are trying to leverage off the experience that we've gained from that particular process. But in terms of stick build, you still couldn't get away. We still had to build the storage tanks on site. So in our case, we were dealing with Arctic conditions. So it was ideal to build it outside and then bring them in, and that was essentially the difference. But I just want to follow up a question, because Delray brought up a really good point, because this is really the issue that's going to differentiate some of when we talk about low-cost providers, because you have to look at the total package. Sometimes everybody just focuses on the top number, price per ton produced, or million tons produced, and we don't look at that, the operating costs, and what are the competitive advantages that you have to drive your operating costs down to be a low-cost producer, because that matters from a difference on, like, my project being fully integrated to, say, Michael's project was more based on a tolling arrangement where he can buy a source of gas, from the marketplace. So it's a little different, and we have to operate all in these parameters. But I agree, the idea is, what is the lowest landed cost, because that really what matters to the consumer.
And I think, Kate, you mentioned a few minutes ago you were distinguishing between North America and the rest of the world, and that's something I'd like to come back to a little bit later. In fact, that was one of the questions I had for later on. I'd like to turn quickly to the commercial innovation side of things. And Andrew, you and I were chatting a little bit about Mozambique, and for obvious reasons, and you had mentioned some of those innovations, including co-purchasing and that sort of thing. How in your assessment was Anadarko able to come up with these sorts of commercial innovations, and is there anything that's preventing other ventures from doing the same thing, if any? What's your assessment on the commercial side of this innovation?
First of all, I'd just like to make a clarification. I was an Anadarko employee at the beginning of August. I then became an Occidental employee. Today, I'm a Total employee. So I've been sold twice in the space of 2 months. So I'm officially supposed to be answering for Total, but I'll give you some of the background of the story. So at the time, Anadarko, as the future operator, it had never developed an LNG project. It was trying to break into the big boys club. So we had to do things differently. Otherwise, why should the industry go to us? We did not go for technical innovation because we just wanted off-the-shelf, de-risked as much as possible, because we'd not been an LNG producer. But when it came to sales, we had no previous portfolio. We weren't bound by precedents that existed with large players that have, and if you've been in LNG organizations and you take something for approval, the first question is, well, is this the way we've always done it? So we kind of had a blank sheet because we were a new player. And at the same time, there was real drive for change in our industry. We came off a period of high oil prices, the Fukushima crisis in Japan, and it was very clear that Asian utilities in particular wanted a different model. And we were able to offer that in several different ways. One was that people have heard me speak before. I've said selling LNG is like selling ice cream. There's a flavor of the month. So when oil prices were high post-Fukushima, everybody wanted to buy Henry Hub LNG because it looked super cheap. And there was a certain model and a certain value at the time that worked. And oil prices dropped down. Suddenly trying to sell that traditional Henry Hub model didn't look great. But that was our window when we came into the market. And what was the market demanding from us? It was asking more for flexibility. So we offered hybrid pricing, not necessarily with Henry Hub. We offered it with European indices. And we offered a flexible DES model. And if I look back in history, I think that's actually going to be the biggest contribution that Mozambique LNG has made to the toolkit of LNG, is that now it used to be only that FOB was fully flexible. We've actually come up with an arrangement that DES is flexible. And if we add on to that the co-purchasing arrangements between a Japanese utility, Tokyo Gas, and a European utility, or JERA as Japanese utility with CPC of Taiwan, those two things really began to create a nice mixture that was sellable to the boards of these companies, that we were pushing the envelope and we were doing something different. And again, in full disclosure, Katan, SocGen is the financial advisor to the project, and so everything we did had to be bankable. So we would test all these ideas with the lending community, working with Katan, and some things that we brought, the bankers were clearly, no, we don't like that, but we did manage to make them comfortable with, with some of those ideas. So those are two of the innovations that I think we have really brought to the table. What are the innovations in the future? Time will tell.
And so really the timing you're suggesting really dictated the need, as opposed to, I mean, that was more a much stronger factor in that regard. And in fact, Kate, I'm going to get to you in a second with regard to the financing point of view, because I think this is, with regard to innovations, not just on cost, but commercial and others, there is a big question about lender buy-in, and we'll get to that in 1 second. But I want to follow up on one thing related, which is the U.S. And with regard to this, this year, and I mentioned this or alluded to it earlier in my remarks this morning, one of the things that we're hearing around the industry, or one of the things we're discussing a lot, is really the evolution of the way LNG is being developed in the U.S. And in this question for everybody, and Michael and everyone else, just I think, where do you see the evolution of the U.S. model in terms of getting projects, to the finish line? Do we still have some ways to go to see the way things are developing, or right now are we at the point where what's going to happen is going to happen with things that we've seen so far? What else is there? Is there anything?
Well, I look at it or we look at it from the customer side. The customer needs are not identical. So some customers want long-term contracts for a stable fuel supply, for a replacement of fuel contracts to produce electricity. And other customers might want shoulder month flexibility, and they're willing to trade some extra price for that. And so there are, and then there's people want different blends or different indices that they're indexing the gas from, even if they want it from the United States. And so the producers or the developers all have to decide what they think the value is that they bring uniquely to the market to try and create ultimately something that can be financed, or if you're a larger player and you're going to do it on your balance sheet, you still have to have buy-in from the capital markets. That, in my opinion, is very similar to a project financing, because if you do it wrong, you'll get punished in the capital markets. And so the discipline is very similar. So it really depends on what segment of the market that you're targeting. In our view, the U.S. has a unique advantage, which is other people's balance sheets fund all the infrastructure, all the E&P, and deliver a stable gas supply to the plant gate. and that there are customers out there that say, I do want long-term contracts. In our opinion, that's still the majority of the demand. And they don't know what the price is of the relative indices are going to be over 20-year periods. And so they have to have portfolios, and they need exposure, and they need to be able to trade it in different basins. And so there's always going to be demand for the major basins because you have to diversify. And so in our case, we wanted to match up the lowest cost of liquefaction, the cheapest refrigerator, with a stable gas supply, which over time sometimes will be expensive and sometimes will be inexpensive, but in our view, it will be generally on the lower end and will be stable. Mark?
We have a perspective because Michael's business model is totally different than my business model. And it is the nature of the game we play in. It's the nature of the geography. It's the nature of the resource base. It's the nature of the legal system, because we couldn't do what Michael's doing in the United States being in Russia. It just wouldn't work in that type of environment. But from an outsider looking in and looking at projects that are being produced in the U.S., our perspective is a little different. And we have modeled out trying to look at where the supply side is going to come in. We estimate that the United States will deliver about 150 million tons. Some are higher, maybe some a little lower, but I think that's a reasonable number. I think when we look at the U.S. model being built out, and we wish Michael and all his competitors the most highest success, because we need those supplies, because it's not a zero-sum game when we come out to the marketplace. We need everybody's source of supply. But where the fundamental difference is Michael's got to buy gas in a market, right? So he's a tolling arrangement. We're fully integrated, so we can deliver natural gas similar to the cost structure that Qatari's talked about today. We can deliver gas into the feedstock of the plant at 10 cents or below per MMBTU, and that's the competitive advantage when you have fully integrated. But I look at the model in the U.S. and I say, well, if Michael invested in upstream assets, if he was an upstream producer, I'm sure he can produce gas cheaper than what he's buying from Henry Hub. If his liquefaction model is based on finance, he sets a structure. I'm sure if it was fully integrated, his cost per liquefaction would be on a cheaper basis than what he would charge somebody to come in on the tolling arrangement.
Cost of capital would be higher, though.
The arrangements are such that it's hard. We're talking about apples and oranges when we're talking about business models, and we all need to be successful because, as I mentioned before, we need all the supply coming from all these particular regions for various reasons, such as diversities of sources of supply, and the market needs it. But it's hard to compare, and we're always being, unfortunately, from a geopolitical perspective, we're always being in this competitive nature, when in reality, it really is not competitive.
I mean, we think the key is no one can predict over extended periods of time what the prices are going to be, and therefore, people that have large fuel needs need to run portfolios, long, medium, short, geopolitical diversification, basin diversification, and as a result, people have demand that needs to be satisfied in all those markets for different customer needs.
But I also think this is all going to be based on Europe as the sink market as well, right? So it comes a little bit to what Mark was saying, that whether it's someone like Michael himself or whether it's just an upstream developer saying, well, actually, I can enter into a contract where I'm contracting on a JLC or a TTF to kind of reduce or eliminate some of that basis risk. I mean, a couple of deals have already been done. But it will also be a function of how desperate those upstream producers are. And what I see with how much gas is going to be appearing in the US, I think you'll probably see a bit more of that. So whether it's the developer, as has been done in a couple of cases, where they're taking an upstream position, or encouraging the producer to share some of that risk, because I can be very clear on this, that there's been no basis risk financed out of greenfield LNG, in the US, because it's just too much of a long-term view to take. Mm-hmm. And frankly, hedging instruments and all of that, they just don't go out that far. So you don't get the liquidity. They're very, very expensive. But that's where, again, the US has an advantage, because they can flip some of this stuff into the capital market. So there's a lot of things at play here.
Well, and on that note, this is a good segue into your view on, in this evolving market, where are where are lenders drawing the line on innovations across the board? Now that might be an unfair question, but every year we always come back to this, and we always wonder, when's there going to be buy-in for contract duration? When's there going to be buy-in for other types of models? Where are you seeing the limits right now in terms of
well, a good way to start, and a shameless pitch, would be we've raised $14 billion for Andrew's project out of Mozambique on an 18-year basis, so that's not been done before. So I think that demonstrates buy-in from the lending community. Look, again, as many have said before me, all of these deals are different. The way I see it going is that lenders absolutely are now going to have to take much more view on shorter-term contracts, introducing some degree of market risk, because clearly, in the backdrop of a strong commoditization, there is more confidence that you can place these volumes, right? The issue is the price. So for, wearing a lending hat is always about, well, is this development going to be cost competitive? So where do I sit on that curve? That hasn't gone away. But you clearly, Michael alluded to the portfolio point. That's a very important point. And there are discussions and structures going around at the moment where you do layer in merchant risk to some of these deals, but where you already have a base of contracts. So you might have 5, 6 contracts that can cover 10 years, 12 years, 15 years, and then over the top of that, you can put in either a shorter term or a merchant facility. And then what really happens with that is that you move to a much more of a dynamic model. It's not the traditional static project finance model, because why would I want to hinder his ability or Andrew's ability to add or remove contracts later? So that's where the dynamic aspect comes in. I've said this before, this is commonly done in the upstream space, right? Reserve-based finance works that way. So that would be one model that we should be using much more, in LNG. And then I think, again, this is where you've got to bring different sectors into play. But if you look at something like LNG shipping, you'll see that lenders there, they lend on a long-term basis, but their amortization is actually different to the duration of the actual tenor, right? So they'll amortize over a longer period. Why? Because these vessels will be redeployed, i.e. there's a residual value. So there's got to be a bit of that coming into play as well. So I don't know, hopefully that gives you a little bit of flavor. I could go on, but,
If I could ask Michael.
So in my view, the market, the investor market, the finance market will always price a particular financing. And I'm old enough to remember a good friend who was bragging about a piece of GE Capital's portfolio and how fast they were growing it, and it was subprime scooter leases in Jakarta. And so you can, and we all remember the subprime market. So the market will price anything. The project finance professionals always measure the next deal relative to the risk or what they did in the last deal. And so whenever they're looking at something new, they decide if they can get it through their credit committee, and then they compare it to other opportunities to put the money to work. And so it evolves over time, but they price it. In order to go shorter in term, which would create more flexibility for customers, which would be good for customers, it shifts the risk more to the lender for the market over building production capacity. And that's the reason why there's resistance, is how do the lenders know that other lenders will be disciplined and not put more production capacity into the market and collapse the price that the lenders took more risk for the earlier financing. And the reason, and you don't know, and the market, because these are big chunky projects, always overproduces and underproduces relative to the demand cycle. And so there's a limit on that. Now, the market could do it. You're going to have more equity put into the transaction to compensate for that risk, which raises the cost, and then that overall cost still has to compete against other producers in the market that can undercut that price. And so there's discipline. You have to be able to crack that nut, and it's really hard to see it happening in the near term, because a huge part of the market still wants long-term contracts, and the portfolio players can afford to have blended portfolios of long-term and short-term offerings in the market.
But I would say, we've talked about technological innovation. We've talked about commercial innovation, and that will continue on. I do think that there's a big gap, and it is on the financing side, particularly the traditional project financing. Katan and I tried to push the boundary on many, many occasions with the ECAs, and there were limits to what you could do. They weren't interested in tail spot sales. They weren't interested in JKM. And I do think we pushed the boundary in a few areas, but other projects now have to come forward, and they're the ones that have to push that boundary even further, because ultimately it should become like reserve-based lending.
But that's the whole point of what's changing. I mean, this was probably the major disconnect between what the financing world was looking at versus what the LNG market was evolving. When you're starting to move into spot sales, bankers don't want to see that. When you're starting to move into markets that are not AAA, AA markets, and all of a sudden you're saying, well, wait a minute, a huge portion of demand is coming from countries that have sub-credit risk. And how do you factor those into the discussions on the financing structure? So this was a major disconnect in many, many projects today, and I assume it's still an issue today.
I would say it's less of an issue. I mean, we've proved it, again on Mozambique, because we have a couple of buyers in there that are certainly, borderline, investment grade. The key that I would say to everyone is the underlying market. So yes, it could have a lower credit rating in terms of a sovereign, but is there a clear need for this gas in the long term? And if we can be contracting, with end buyers, a lot of which actually end up having captive market, well, there's a strong story, to be made out of that. And again, maybe it's starting with the portfolio approach, but Mark, in my view, there's no reason why any of those more challenging markets cannot be financed.
It's interesting. And with the remaining time that we have left, I'd like to turn to the social license question. And, and the theme of our conference is strategies for the energy transition. The social license piece of the puzzle here has always been an elemental part of project development, but now we're seeing even, more than ever, the climate and emissions mitigation piece is really coming to the fore. Now, aside from renewable power, Delaware, we've been talking about Shell and LNG Canada, for example, and and that kind of innovation, if you'd like to call it that. But I think the real question here is how much of a priority has it really become? The climate and emissions mitigation part of the project development puzzle, relative to other company operations. I mean, where does the LNG project development stand with regard to broader company climate issues?
For us, I fortunately don't struggle with that question, because evolving our portfolio and leading on the energy transition at the pace that is needed is something that's core company strategy. So that really isn't a sort of a strategic debate we're having on the extent to which we need to go and find ways to green the chain, so to speak, right? And whether it's reducing emissions in the upstream, whether it's designing new LNG facilities with lower greenhouse gas footprints, integrating renewables, integrating hydros, looking at ways to have jettyless regas, for example, the whole chain all the way to the customer. We're very actively working on reducing the greenhouse gas footprint on that of that chain. And that's really important because it's part of the narrative. And as long as, we've often said, as long as the industry is not entirely on the right side of the argument on things like methane emissions, we invite the sort of scrutiny that, that we face today. I think we're all confident that our product has a really important role to play in the bigger global energy transition when gas plus renewables displaces coal or grows the power mix instead of coal, when gas replaces a heavy fuel oil or diesel. That's all fantastic. That's all a critical part of the global energy transition narrative. But we also have to earn the right to be at the table by ensuring that when that product lands in the arms of the customer, that the greenhouse gas footprint of every molecule that we sell is as low as it sensibly can be. I think more and more our customers will demand that. I think more and more our customers will demand transparency, so we'll have to label, and for me this cannot come quick enough, where we have to sort of label the greenhouse gas intensity of molecules when you deliver it into the market. I think that scrutiny and transparency will be very good for the industry, and we will have to pay for the greenhouse gas associated with that as well.
Anybody else?
I mean, I think what we're faced today is climate change is the defining topic of this generation. And I mean, you just look around outside when we look at the millennials who are absolutely opposed to the oil and gas industry, and we have to find solutions to address many of these particular questions. You know, I agree with Ray. I mean, gas is only one solution, but it is an important solution because without gas, we would have not seen part of the transition we've already made. And so you have government policies, you have industry that has to take a role in this particular question, and we need to go into some of these societies and possibly improve the education of what the industry is doing, formulate, you know, obviously the methane question on how do we capture and report methane issues, because the coal industry will continue to attack us on this one question, you know, that we don't have our grips on methane. And I think it's just a process of when we get to that right price, when we can be able to transition to a point where infrastructure is built out to accept gas, you then have to have price gas that competes with coal to make that energy transition. And I think if we do that, I think we'll make a large contribution to climate change.
Very good. And in the time we have left, what I'd like to do is I'd like to open it up to questions now. And if I can ask you to stand, state your name and affiliation, that would be helpful. And if there's somebody you'd like to address your question to specifically on the panel, please indicate. Yes, here in front. Wait, mic coming.
I am a fan from Leaders for Tomorrow program. I'm also working with Potent Partners, an LNG consulting firm. So I have a question about LNG as a commodity. We know last month CME Group just announced that LNG can be traded as a commodity based on Henry Hub price. But actually, as a global speaking, there's no market clear price globally. How will we see the price mechanism globe in the following years compare Asian markets and like NBP, TTT, like in Europe? So what's the future of the LNG as a commodity?
Well, I have my own views on that. I think we're on a journey. If I look back in my career, which is 30 years in the industry, we've definitely come a long way from when it was just pure oil-linked contracts. Typical standard price was $14.85. If you look at the diversity that now exists within pricing, it's immense, but we're not there at a single globalized commodity price today. I think what it is it's regional, but the regions are increasingly being linked. And because the contracts are becoming flexible, if a buyer puts up his hand and says, I want to buy a cargo, in the past, there was only a couple of people that could release a cargo. Today, every buyer and every seller can practically release a cargo. And therefore, there's multiple cargoes available in multiple places in the world to satisfy the demand. So the pricing is regionalized, but there's increasingly convergence. And you see efforts with Platts, for instance, with JKM, that it's amazing to see how the paper products are being traded. I don't know in 2-3 years, are we actually going to have a forward curve of maybe 6-7 years? Maybe we will. So it's moving in the right direction, but we're not there yet today. That would be kind of my...
I agree with everything that Andrew just said. I would add a small point, and that's at the entrance of the big trading houses in the last few years, the Glencores and the Traffys and the Vitols, who our solely traders are positive additions to the market and increase more the velocity of the trading, and that will continue over time.
Yes, actually for us, looking at it from a Shell perspective, this is not a question that we wonder about or worry about. I don't think we'll ever see a global LNG price. It would be nonsensical anyway for a price of gas, because LNG is just gas, right? So this is about gas pricing. Will you see a global gas price? No, you'll never see a global gas price. Why is that? For a whole handful of reasons. Why should the price of gas and what drives the price of gas in the United States be the same as in Vietnam or in the domestic market in China or something like that? There are very different drivers. I think what you will see is that the short-term indexes that sort of clears the market within different regions on any given day will converge more towards each other. That's what we're seeing. That's what's commonly called convergence or commoditization of gas. And there will be, these things will talk to each other more, and there'll be more depth and more liquidity, and you'll be able to hedge a bit further out. But will you see a global market for natural gas per se? I think it's very unlikely. When we engage with new customers, for example, a customer that converts from a liquid fuel in rural India from diesel to gas, or a shipper that converts a vessel from marine bunkers or marine diesel to gas, do they necessarily want to buy on a hub plus basis? For the long term, not necessarily. And I think increasingly many of our customers are not just buying gas. They're buying risk mitigation, future demand uncertainty, hedging them against that, helping them manage price volatility. And so we see a whole new segment of the market where it that we're selling to the customer is far more sophisticated than just selling them methane molecules on a long-term contract. And that's highly customized, right? What's your need? What index do you prefer to buy on? What are the other issues that you want to mitigate against, legislate for, or risks that you want to control? There lies a big part of the future growth for gas, and that's not price specific.
And I also think you have to take into consideration the seasonal effects. Certain markets are going to be winter rate based, and certain are going to be summer, and you have a completely different usage. I mean, we're trying to create, given the expected volume coming from the Arctic region, we're trying to create a FOB shipping price or FOB price in Kamchatka on the Far East, because we see that there's opportunity in the Asian Pacific market that want to be able to get a physical volume price taken from that particular location to market. But I think all the points that were well said here, and I would just add that there's seasonal issues too that have to be addressed.
Another question? Yes, over here. John?
Hello, John Roper from Uniper. I have a question to Katan and Andrew. I'd be quite interested to know who the just above junk status buyers were that were part of your product, and seriously, whether that actually speaks to the difficulty of taking FIDs on non-US projects. I mean, Andrew, please lead away.
Those were his words, not mine, and I point out he must be referring to Shell. The banks accepted all our contracts as bankable, so we're happy with the customer mix.
We have time for one more, I think. One more question. Or maybe not one more.
Lunchtime.
You know what? And I think because it's lunchtime, I will wrap it up there. And please join me in thanking our distinguished panel. And thank you for your attention.